Hello everyone, and welcome to Stock Unlock's first video on this channel, well, outside of like a tutorial or anything like that. In this video, we're going to be talking about two stocks that I think are super cheap in this market right now. And full disclosure, these two stocks are more controversial stocks, and honestly, it's probably because they're so controversial that they're selling so freaking cheap right now. Also, I just want to make a really quick disclaimer that this is not financial advice from Stock Unlock in any way. I'm just going to be sharing you guys my information, my research, and using the Stock Unlock platform to show you how you can come to your own conclusions, or even really just question my own conclusions. So with that being said, let's hop into Stock Unlock, and I want to show you guys the two stocks that I think are looking very cheap in the stock market right now. All right, so the first stock is actually Alibaba. And I know a lot of people are probably going to be disliking this video right off the bat because it is a Chinese stock, but I mean, when you take a look at the underlying fundamental performance of this business, it is looking rather cheap right now. And take a look at this. Back in about, what is that? That's about October of 2020, Alibaba was selling for $317 a share. And if we take a look here, it is now in about a 71% correction. So Alibaba has lost over 70% of its value in less than 2 years, in about 18 months. And at the same time, the underlying fundamentals of this business have only been improving, at least in my own opinion. Now, the reason that Alibaba is selling off so hard is, one, because it is a Chinese company, and right now not a lot of investors are attracted to investing in China in general, and a lot of investors simply do not trust China right now. Honestly, fair. I mean, China has been cracking down on their overall economy and putting fines on their tech giants like Alibaba and Tencent, but I do believe that the Chinese government is going to start supporting their overall economy and supporting their large tech companies like Alibaba going forward. These companies provide billions of dollars in tax revenue for the Chinese government, and I don't think that it is in the Chinese government's best interest long term to totally derail these companies like Alibaba. And what's also interesting is that over here in the West, and really in Europe even actually, governments are tightening their monetary policies right now. What that means is governments are increasing their interest rates and they're actually doing quantitative tightening. So they're actually sucking money out of the economy now. But this is the opposite of what China is doing. China recently announced that they're actually going to be lowering their interest rates and providing quantitative easing for their overall economy. So basically, China is stimulating their economy right now through lower interest rates and printing some money, at the same time as the rest of the world is tightening and raising interest rates and sucking money out of their economies. In my opinion, I actually think that this is bullish for Alibaba because they are one of the leading companies over in China. And I think that the Chinese government stimulating the Chinese economy, again, is ultimately just going to be bullish and provide tailwinds for Alibaba. So now let's head over to Stock Unlock's financials tab right here. And I want to show you guys Alibaba's total revenue over time, because we can see that Alibaba is producing a record amount of revenue right now. But if we click this box right here, we can see the percent change to the growth of Alibaba's revenue. And we can see that in the most recent quarter, Alibaba's revenue only grew by about 2%. And this is the lowest amount of revenue growth that Alibaba has ever seen in its time being a public company. So basically what this means is that Alibaba is still growing and it's producing a record amount of revenue right now, but it's not growing that quickly. It's seeing a record low growth. Now, if we also head over to Alibaba's cash flow statement, we can see that Alibaba's operating cash flow peaked right here in the first quarter of 2021. And ever since then, Alibaba's operating cash flow has actually been declining. This is just because Alibaba, like Amazon, has been seeing increased inflation and increased expenses, and the company has really been investing in a lot of future growth. Also, there has been some lockdowns and shutdowns and really just supply chain shortages all over the world, and especially in China. So that has also been harming Alibaba's profitability and its operating cash flow, and really harming Alibaba's overall margins. Now, as I said, this is kind of the same thing that has been happening to Amazon. So if we just go and take a look at Amazon's financials here really quickly on Stock Unlock, we can see that Amazon's operating cash flow also peaked in the first quarter of 2021. And ever since then, the operating cash flow that Amazon has been producing has been declining. This is the exact same trend that we are seeing for Alibaba. What's interesting is both Amazon and Alibaba in their first quarter earnings have said that they're going to be spending the rest of 2022 and 2023 increasing their operating efficiency and getting those margins back up. Alibaba has actually said that their number one focus for the rest of 2022 and 2023 is producing a large amount of operating cash flow. So I do believe that Alibaba is going to be able to grow that operating cash flow and get it back to at least previous highs, and then over the long term continue growing it. So now let's head over to Stock Unlock's freeform tool right here. And this is a tool that we use to just compare companies' fundamentals. And we're going to be taking a look at Alibaba and Amazon's free cash flow right here. And right here we can see that in the trailing 12 months, Alibaba has produced $13.4 billion in free cash flow, and Amazon has produced negative $25 billion. So right now, Alibaba is actually producing more cash flow, free cash flow, than Amazon. But if we take a look at the operating cash flow that both of these companies generate and get rid of free cash flow, we can see that Amazon is generating more operating cash flow. Still, Alibaba is generating more free cash flow than Amazon right now. I think that that is very interesting and something important to note. So now let's get rid of Amazon right here. And I want to show you guys Alibaba's total cash position versus the market cap of the company right now. Because Alibaba's market cap is about $251 billion and their total cash position is about $68.3 billion. So basically Alibaba, about one third of Alibaba's market cap is sitting in cash on the balance sheet right now. So this company is incredibly cash rich. I think that that is very interesting to note. And lastly, I want to take a look here at Alibaba's price to free cash flow, because right now it is sitting at 18.7. And we can see that since about 2015, Alibaba's average price to free cash flow has been about 28. So right now, Alibaba is selling well below its historical price to free cash flow average. And yeah, I think that a price to free cash flow of 18.7 for this business is actually looking very attractive. Now, also, I think that Alibaba is going to be able to continue growing its revenue over the long term because Alibaba is a cloud provider and they're actually the #1 cloud provider in China. And check this out. This is China's cloud infrastructure services spend forecast out to 2026. And we can see that by 2026, China is projected to spend about $85 billion a year on cloud infrastructure, whereas right now they're spending about $35.4 billion. So China's cloud infrastructure spend is projected to more than double over just the next 5 years. And check this out right here, because Alibaba Cloud currently has 37% of China's cloud market share, and they are the largest cloud provider. So as China's cloud infrastructure spend continues increasing over the next 5 years and really over the long term, Alibaba is set to benefit massively. So I do think that Alibaba is going to be able to continue growing over the future. So now let's head over to Stock Unlock's valuation tool, which is our discounted cash flow calculator. And we are going to be tracking Alibaba's operating cash flow right here. And I'm going to say that I am expecting Alibaba to grow its operating cash flow at 10% over the next 10 years. I am also going to say here that in 2032, in the next 10 years, that Alibaba is going to trade for a price to operating cash flow of 20, which is actually below its 10-year average of 23. And also I want to point out that the operating cash flow growth of 10% over the next 10 years is about half of the previous 10 years, which was about 20%. So I think that both of these numbers are actually a little bit conservative, and I like to be conservative when I do my DCF projections. Now, the shares outstanding growth rate, I'm going to say that Alibaba is going to buy back about 2% of its shares on an annual basis, which I think is also a little bit conservative because the company is buying back a substantial amount of shares right now. When I input all of these numbers in our Stock Unlock DCF calculator, it tells me that the discounted fair value of Alibaba shares is $195 a share, which is 87% higher than where the shares are currently trading. It also tells me that if all of these metrics come true in the future, then Alibaba's future stock price in 2032 should be about $506 a share, or 386% above where the stock is currently trading. So when I input all of these metrics, which I believe are actually quite conservative, it tells me that Alibaba is selling quite cheap right now. And again, the discounted fair value is 87% above where the shares are currently trading. So personally, I think that Alibaba is looking very cheap in the overall stock market right now. That's just my opinion. That is not financial advice. And using Stock Unlock right here, this is how I came to that conclusion. But let me know what you guys think down in the comment section below. Now, let's move on to the second stock that I think is looking very cheap in this market. And as I said, it is another controversial one, and this one is Facebook, also known as Meta Platforms right now. And let's actually just zoom in here really quick, because right here in about September of 2021, Facebook was selling for about $382 a share. Now the stock is in this absolute massive correction, and it's lost about 50% of its value. So Facebook has literally lost about 50% of its value in less than a year. And I believe that this massive downright crash that Facebook stock has seen over the past year has created this massive value in the company and actually taken out a lot of the risk associated with Facebook stock. Now, the reason that Facebook stock is in this massive correction, or a downright crash, if you want to call it that, is because the company is shifting its focus to the metaverse. And this is going to require tens of billions of dollars in capital expenditures and investments really over like the next decade probably. And no one really knows if the metaverse is going to play out, or if all of these investments that Facebook is doing is going to yield a return for shareholders over the long term. So basically what happened is Facebook shifted away from just being a social media company to being this metaverse company, and honestly a bit more speculative, because again, no one knows for sure if the metaverse is going to play out for Facebook. In my own opinion, I think that at this price, this 50% correction that Facebook stock has seen, I actually don't think that the metaverse even really needs to play out for Facebook anymore, because its family of apps business is selling for an incredible price at this valuation here. Now, also, people are bearish towards Facebook right now because it is seeing increased competition from its rival TikTok. TikTok is absolutely exploding right now in the short video form market, and Facebook announced Instagram Reels to actually compete against TikTok. And I have some screenshots right here that I want to show you all of Instagram Reels. So right here, this is Google Trends interest over time for Instagram Reels, ever since Instagram launched it in 2020. And we can actually see that Instagram Reels interest over time is uptrending, and Instagram Reels interest is actually sitting at an all-time high right now. And what's also interesting is Instagram Reels interest and growth is largely being led by India. This is interesting because India banned TikTok because TikTok is a Chinese app, it's a Chinese platform, and India and China are not friends, to say the least. India banned TikTok, so basically Facebook does not have to compete against TikTok in India, and that is where a lot of Facebook's growth is actually coming from. Or basically it just means that Facebook does not have this massive competitor and this massive rival in India, which I also think is going to be the largest growth engine for Facebook over the next few decades. So I think that this is very interesting to note. Now, what's also interesting is that in 2022, Facebook is projected to have 505.26 million users in India. But check this out, because by 2040, Facebook is projected to have 970 million users in India alone. So there is still massive room for growth for Facebook in India, and Facebook is projected to capture a lot of India's future growth. Now, what's also interesting is Facebook now reports their Reality Labs revenue, which is like their metaverse revenue. And we can actually see that over time, Facebook's Reality Labs revenue has been growing. And year over year, it grew by over 20%. In the first quarter of 2021, it produced about $534 million in revenue. And in the first quarter of 2022, it was nearly $700 million in revenue. That is really strong growth, and I am excited personally to see if Facebook can continue growing their Reality Labs revenue over time. Now, also, I have a screenshot right here from Google Trends of Oculus. This basically just shows Oculus interest over time, and this is all the way back over the past 5 years, so to about 2017. And what's interesting is we can see that Oculus interest over time is consistently uptrending. These spikes right here are right around Christmas when everyone is gift shopping and spending money, but we can see that every single year during Christmas, Oculus becomes a hotter topic and people are searching for Oculus quite a bit more. What's also interesting is Oculus's interest is coming mostly from the United States, Canada, United Kingdom, Norway, and Denmark. What's interesting, or why this is interesting, is because this is still like the Western world. So Oculus still hasn't really even taken off yet in countries like India. So I think that there still is a lot of growth for Oculus over the long term. And check this out, because right here on Amazon, Oculus is one of Amazon's choice products, and Oculus has 78% 5-star ratings and then 13% 4-star ratings. So that's basically 91% of people that use Oculus and rate Oculus give it either 5 stars or 4 stars. So consumers really seem like they love Oculus, and I think that Oculus is only going to continue getting better over time. And also there's almost 37,000 ratings right here on this product. So I think that a lot of people really like the Oculus product. And again, I only think that this product is going to continue getting better over time. So I think that Facebook is set up nicely to continue benefiting and growing from the metaverse and their metaverse products. So now let's head over to Stock Unlock Insights. And this page really just grades and scores the different key fundamental metrics of a business and all of its financials. This page is not meant to be a buy or a sell recommendation, but it's meant to just show and highlight all of the key things that investors look for in a business. So let's take a quick look at Stock Unlock Insights right here. I want to take a look at Facebook's profitability because it has a perfect score of 5.0 out of 5. The gross margin is over 80%, operating margin is 37%, net and free cash flow margin are above 30%, and the cash conversion is over 100%. So Facebook is a highly profitable business and it is an absolute cash flow machine. So it gets a perfect 5.0 out of 5 on Stock Unlock's profitability. Now, if we take a look at Facebook's growth, it has a score of 3.4 out of 5. The revenue has grown by 27% over the past year. Net income was about 11% and free cash flow grew by 65% over the past year. The reason that Facebook isn't higher graded is because the book value and the tangible book value are decreasing, but this is because Facebook is spending its cash position to buy back shares and buying back as many shares as the company possibly can while the share price is low. The financial health for Facebook is also sitting at 4.3 out of 5. The current ratio is above 3. The shares have decreased by 4.5% over the past year, and the company has more cash than total liabilities. If Facebook wanted to, they could use their cash position right now and knock out every single debt that the company is currently sitting on. Facebook, in my opinion, is very cash rich and it has a phenomenal balance sheet, okay? So when I'm taking a look at our Stock Unlock Insights right here, I'm seeing a very profitable business with incredibly high margins that's also growing the revenue by double-digit growth rates, 27% over the past year, and the free cash flow has grown by 65% over the past year, and it has an incredibly strong balance sheet, current ratio near 3, more cash than total liabilities, and it's buying back 4.5% of the shares over the past year. So I think that this is a very fundamentally sound company. So lastly, let's go and take a look at our discounted cash flow calculator for Facebook here on Stock Unlock. And I actually want to project out Facebook's free cash flow. And let's say that Facebook is going to grow its free cash flow by 5% annually over the next decade. Let's also say that we are going to expect a 20 price to free cash flow for Facebook over the next 10 years. And let's say that they're going to buy back 3% of the shares every single year, which I think is actually a little bit bearish because the company is going to buy back like 4 to 5% of the shares annually, at least in my own opinion. Now, when we enter in these inputs to Stock Unlock's discounted free cash flow calculator, we get a discounted fair value of about $250 a share. And if all of these metrics come true in the future, then Facebook should be selling for a share price of about $650 by 2032. Now, if we also scroll down and we take a look at the free cash flow projections for Facebook out to 2032, basically it shows us that by 2032, based on a 10% free cash flow growth rate, the company will be producing about $65 billion in free cash flow. And if we take a look, in the trailing 12 months, the company has produced about $40 billion in free cash flow. So basically, I am just looking at this chart right here and I'm going to ask myself, do I think that Facebook can grow its free cash flow by about 50% in total out to 2032? And in my own opinion, I believe that Facebook can. I also believe that Facebook is going to be buying back a lot of its shares. And I think that, Facebook selling for a price to free cash flow of 10 years out is also quite conservative. So basically, I think that these are very conservative numbers here on Stock Unlock's discounted cash flow calculator. And when I put in these conservative numbers, we still get a discounted fair value of Facebook of about $250. So personally, I think that the market is being quite bearish towards Facebook right now. And I think that long-term investors can take advantage of this and potentially buy Facebook if it is looking cheap. And personally, I do think that it is looking cheap. But again, let me know your thoughts down in the comment section below. But that's also going to wrap up the video, everyone. And if you enjoyed this video, then please remember to leave a like on it. And if you are interested in Stock Unlock, then we will have a 7-day free trial link at the top of the description. All you got to do is click that link, enter in your email. You do not need a credit card or anything, and you can get full access to Stock Unlock. This is an absolutely fantastic research and educational platform, and I would love to have you guys on Stock Unlock and at least come and try it out. So again, there will be a 7-day free trial in the description. And yeah, so thank you guys so much for watching. And if you enjoy this type of content, then please consider subscribing to our Stock Unlock YouTube channel as well. But that's going to wrap up the video, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in our next video.